Good morning. Welcome to Real Estate Economics webinar series. Real Estate Economics publishes a webinar on a bi-weekly schedule covering a variety of topics of interest to the home building industry. If you're not familiar with us, you can always find the schedule at www.realestateeconomics.com. These webinars are posted to YouTube at youtube.com/realestateeconomics. Once you're at YouTube, you can click the link at the top labeled All, that's ALL, and see our past presentations. From there, you can click the presentation that you're interested in and watch it at any time. Here's our upcoming webinar schedule. 2 weeks from today, we'll be presenting our Northern California forecast, followed by the Fresno market forecast, then Denver, then Seattle. On July 13th will be the National Economic Overview, and on July 27th, we'll be featuring a webinar on renewable energy. Today we're going to do a slightly different topic than our market overview and some of our market information reviews. We're going to talk about a recent ruling that affects land development, master plan, community development, municipal financing, CFDs, Mello-Roos, and those issues. This is called Azusa Land Partners versus the Department of Industrial Relations. To provide just a bit of background, Azusa Land Partners is the sponsor of a major master plan community called Rosedale, the former Monrovia Nursery property, in the city of Azusa in LA County. This is a full-scale master plan community with over 1,200 homes, schools, a metro rail station and undercrossing, bridges, and commercial space. The great thing about Rosedale, from a market perspective, is it's within a short commute of millions of jobs in LA County, stretching right into downtown Los Angeles. As part of the approvals and the development agreement for Rosedale, the sponsors agreed to construct a wide range of public improvements, and to do that, they formed a community facilities district to pay about $71 million of the total budget of $146 million. The balance was to be privately funded. As required under the Mello-Roos Act, all of the public improvements would pay prevailing wages in compliance with California's very, very old prevailing wage law. Subsequent to the development agreement, which, if my memory serves me correctly, was about 2006 or 2007, the Southern California Labor Management Operating Engineers Contract Compliance Committee sought a ruling from the State Department of Industrial Relations that all of the proposed improvements be considered public improvements, since they were paid in part by public funds. The sponsorship, Azusa Land Partners, appealed this to the Superior Court, to the Court of Appeal, and ultimately to the California State Supreme Court, where the State Supreme Court turned down the case, decided not to hear the case, essentially leaving in place the ruling of the Department of Industrial Relations as upheld by the lower courts. Under this ruling, privately financed improvements would be considered a public work if public funds, the Mello-Roos, were used in any part of the development, thus requiring that prevailing wages be paid on all skills and trades throughout the entire development. Now, this is going to apply to school sites, public roads, and anything that's in the public domain. It doesn't apply to the specific lots and homes, but still the consequences are quite far-reaching, as we'll address here. So what are the ramifications of this particular ruling? One of the things we believe we're going to find is about a 10 to 15% increase in land development costs. We've had some of the cost engineers we work with give us some opinions on this. There's also been some estimates made by local cities to understand the cost effect for their work on public buildings and public works. So 10 to 15% is about our best estimate at this time. Over the next months and years, we'll expect to see budgets come out that will firm this up. But at present, we're expecting sort of a character change in land development budgets. We think the land improvements are going to be increasingly front-end loaded. Some of the items that have at times been funded by Mello-Roos, including water, sewer, underground improvements, those will have to be paid out of borrowed or developer funds much earlier in the process. We believe that developers are likely to use the CFDs when they use them for non-labor related cost categories, including school fees, development fees, municipal fees, however you'd like to phrase that. Now, since the land development expenditures take place far earlier in the timeline than the payment of school fees, which are frequently a building permit, that commits the sponsors of these major master plan communities to fund these improvements several years before school fees and development fees are often funded. So what does that do to a master plan community deal? We think that many of these deals and existing properties will be reshaped or restructured to contain these costs. Certainly everyone's going to do what they can to limit the exactions in terms of public improvements, but also we think there's budgetary measures that can be taken to improve the efficiency of the trades that are working on these particular developments, to make some of the infrastructure not as far-flung, to reduce over-engineering wherever possible, and to streamline and make as cost-efficient as possible all of the trade areas where prevailing wages are going to apply. Just as a general overview, we think this is going to add cost pressure to all major infrastructure items. Of course, it's the underground sewer, water, that sort of thing, drainage that we see in all of these communities. We think those budgets will be stressed, but also school construction financing is bound to come under pressure, and maybe that will ultimately sponsor a change. We've heard some opinions that the BAA or interested parties may actually try to make some legislation on this area so that school funding in particular is not as heavily impacted. We've also seen pressures, maybe not pressures, but some disruptions in the municipal bond market that's taken place as part of the larger credit crisis over the last several years. Muni bond issuances are way down in the past several years. Many cities and municipal entities have been unable to refinance their bonds and have essentially had those credit instruments rolled over at their current lenders just so they didn't have to requalify and move forward with a whole new credit instrument. We think new CFDs and Mello-Roos coming to market are going to include a much more detailed examination of the creditworthiness of the sponsorship. Many of the entities that are prone to sponsoring CFDs, school districts, water districts, and different entities like that, their credit profiles are not what they have been in the last several years. The examination of their credit is bound to be far more rigorous. Many of these areas have unfunded pension liabilities and high levels of employee costs compared to their total income. And so we think that's an area that's going to put a little bit more scrutiny into the CFD process. Today we'd also like to address briefly trends in construction costs. First thing we're going to go to is to current lumber futures. Many of you probably recognize this. This is 2x4 random length framing lumber traded on the Chicago Mercantile Exchange. The right scale has the price in dollars per 1,000 board feet. The range is $240 to $340. This is the current May 2011 contract. What we'd like to call out in this profile here is during the life of this contract, there was, way back in December of 2010, some optimism in terms of the market recovery, the market performance for housing, and therefore lumber futures appreciated, running up from about $280 to the $330 and $340 range. During the course of the winter and early spring, it's become apparent that starts, although improving, have not been that great. The spring selling season, although decent in some areas, certainly hasn't been excellent on a nationwide basis. Builders are ordering less lumber, taking delivery of less lumber. Lumber is a commodity that just has no real hoarding value or stockpiling value, and so people usually order it for just-in-time deliveries. There is a pronounced seasonality in this contract, with almost all users of lumber wanting to acquire lumber in the spring and have it on the shelf for the spring and summer construction season. Let's take a look at this on a 2-year basis. You can see two big spikes in this contract, calling out really an anticipation of greatly improved economic conditions in 2010. That didn't really come to pass, so seasonality and weak sales drove that contract way down from 320 all the way into the under 200 range. Then, when 2011 was on the horizon, the optimism about a more robust spring recovery and economic recovery ran up, and again, the contract rose quite steeply, only to fall back. In the last few days, this contract has been under $225 per square foot, with a little bit of improvement just in the past day or two, up to about $240 per foot. Let's look at copper prices. When you think of home construction, everybody wonders where the copper goes. It's not so much that there's copper, in this item or that item, but so many parts, so many components, so many of the finished goods in a house contain copper. Appliances, wire and heating, insulation, manufactured goods, completed goods that go into the house. This is why copper is often called Dr. Copper, or the construction material, the commodity, if you will, with a PhD in economics, because it's quite sensitive. You can see in this copper chart that the price ran up considerably in 2010 in anticipation of improved economic conditions, pulled back considerably, ran up again, somewhat similar to the lumber contract in 2011 in anticipation of improved economic conditions, and now showing a little bit of softness. China is a major user of this, of high-grade copper, using about 40% of the world supplies. So they are the producer at margin. When they buy a lot, that's really taking any excess supply off the market. So when they buy, prices rise. When they tend not to buy, prices decline. We think we might get a little pullback here as the dollar strengthens in the next few weeks and months, which we'll talk to in a coming slide. Let's look at interest rates. This is a 10-year note measured in Treasury yield and the rate that it pays. You can see there's a big dip in the middle of this chart coming in the end of 2010, when QE1 was really determined to be not fully successful in stimulating the economy back to a self-propelled, if you will, condition. Initiating QE2, then we've been trading at the right-hand side of the chart in a defined range between about 320 and about 370. At present, that number's come down quite significantly in the past few weeks, from about 3.6% to the current number shown, 3.137%. Once the QE2 ends, or the market decides that QE2 is likely to end, these rates are likely to rise. It may not be severe, but that would bring dollar strength back to the market, and that would put a firming of commodity prices under copper, under lumber, under most imported items. So we think some of the severe price increases that have been observed in commodities and in different materials over the last few weeks and months may be consolidating their gains or retrenching a little bit here in the next couple of months. One of the things we keep track of here is labor costs. This is for California. My apologies if this is a little bit difficult to read. While the commodity side's been quite frothy in the past few weeks and months, the labor side certainly has not. Labor continues to be abundantly supplied and facing tremendous pressure to keep a lid on wages. Almost all manufactured goods, which includes anything like a house or something that involved construction, assembly, or manufacture, then labor is a huge component, 60, 70, 80% of the total cost of that good. They often will say that, a loaf of bread, for example, has 5 cents of wheat in a $2 or $3 loaf of bread. That's true for many commodities and many finished goods. So as long as the labor side is contained, it's unlikely we'll have huge cost inflation in house costs, at least until unemployment starts to drop off. These high levels of unemployment are definitely telling us that we have surplus labor and that there's great competition for employment out there. One of the things we'd like to incorporate into this macroeconomic overview is a picture of the California employment conditions. This is employment change by supersector, measuring year-over-year change in the major employment categories that the government uses to measure employment. This is from March 2010, so this is really a year-ago view of the California economy. You can see we are almost universally negative, with substantial job losses in construction, followed by manufacturing, trade, transportation, utilities, government, professional business services, literally all areas of the economy aside from education and health services. Let's come forward 1 year and see the character change that takes place from March 2010 to March 2011. Now, a full year later, we have employment growth in most of the categories, certainly more than half. We're still losing in government. Financial activities tends to be a little soft, although many of the banks and lenders are adding people to deal with their asset management issues. Construction is still decidedly negative, although far less so than a year ago. And we're actually seeing some manufacturing gains here, 4,100 jobs. Most of the nation is already experiencing substantial improvements in their manufacturing climate. Nationally, manufacturing employment is up 33 of the last 36 months. California is definitely slow to come to that party. In fact, we have seen employment improvements in most of the hard-hit states across the nation, including places like Michigan, South Carolina, Rhode Island. Some of the states that had the most severe unemployment have already rebounded by 1 to 2 to 3 percentage points in terms of lower unemployment. California is essentially just on the cusp of that recovery and starting to show some growth here, and hopefully that will accelerate in the months ahead. So really, what's the conclusion of what we've talked about here today? The easy monetary policy that the government put out in terms of QE1 and QE2 has a variety of factors that affect the California economy and the residential construction industry. Money tends to flow, easy money tends to flow into capital-intensive industries, and that includes information, technology. You can see the explosion in the wireless products. And this is a big benefit to California because of all the high-tech concentrated in the South Bay, San Jose market area. The Varians, Tibcos, Facebooks of the world, all these companies tend to draw a lot of inexpensive capital when cheap money is available. Now, earlier in the decade, we had a dot-com boom and bust, but we think venture capital is far more restrained. In this cycle, the money that's going into these high-tech industries isn't going into, some half-baked ideas like we saw in the dot-com, but they are instead going into not only technology, but biotech, communications, and a whole bunch of fields that are likely to produce far greater returns, including renewable energy, than some of the ideas of the dot-com boom and bust. Now, some of this easy money also tends to flow into commodities. We've certainly seen that in terms of gas, food, gold, silver being the latest thing to just go parabolic. But over time, when the QE2 becomes withdrawn, and if it becomes fully withdrawn, that'll lead to a firming of the U.S. dollar, and that will tend to put a lot of these commodities under tremendous pressure and sort of contain some of the high run-up in costs that we've seen so far in 2011. Pending market improvements in year 2012, we think are going to be driven by undervaluation and improving economic growth. Now, we know across the state, particularly in the coastal areas, with a concentration in the high employment markets, that residential real estate is significantly undervalued despite the downtrend we've been experiencing. We can tell from household income, from current interest rates, and from the percent of that household income that households will allocate to their residential mortgage payment, that housing's tremendously undervalued. This undervalued and the undoing of the undervalued condition, this undervaluation and the correction of the undervaluation is going to lead price appreciation in 2012, accelerating, we believe, over 2013, 2014 and the back half of this decade. People often say, well, if the market is so undervalued, how come we're not seeing that? Well, in fact, we are. You can see in many markets there's 20, 30, or 40% all cash buyers buying homes that present good rental opportunities. They can quickly buy these homes, return those to the market as rentals with positive cash flows, and hold that for a 5 or 10 year market window and then sell it at, we think, a highly appreciated price. Now, if you are unsure about your employment situation, you're unemployed, you're tied to a home that's underwater as we speak, then you're obviously not shopping for a house. But high-income people, landlord types, people who've been through these cycles before, can recognize the amount of the undervaluation. And as we get some economic growth and we start to see some unwinding of the distress in the market, the undervaluation will be more universally recognized. In this next cycle, we expect mobile buyers and mature market demand will be a driving force. One of the things that's taken place in this particular cycle is buyer mobility has been really held in check. Many people bought a home using a subprime mortgage and were stuck in that home by that mortgage and didn't move when they became unemployed. Now, if you get 99 weeks of unemployment, you can fight the need to go get a job for quite some time. But as the 99ers have run out of benefits, people have increasingly become mobile. We've seen this over the last 6 to 12 months. People are following jobs and going wherever they need to find employment. The industries, during a recession, many industries are compressed and changed, or if not driven out of business altogether. And these changes take place not only within industries, but within states and municipalities. We think many businesses are moving to friendly employment environments, and buyers are ultimately going to follow them to those areas. You can see the demand in Texas has been quite robust. Texas has created more than 1 million jobs in the past 3 years, and buyers have followed the employment there. We also think mature market demand will become very important. There are many people who would like to cash out their accumulated equity in high living cost states and take some of that equity, live on that, but take another portion and buy a suitable home for their retirement, whether that's in an age-qualified community or not. Many people will use some of that money and then keep quite a bit of that in reserve. So mature buyers are going to consider low-cost states, but they're also going to consider staying close to household friends and family in their existing area if they can find their right opportunity. So we see unique opportunities across the state for boutique mature market developments, generally close to work. Mature buyers are staying in the workforce for much longer times these days to much older ages, and we think they'd like to be closer to suburban and urban areas where they can get to the job base. Last, U.S. real estate is going to look increasingly cheap on an international basis. At present, we've seen the U.S. dollar devalued to multi-year lows. In many countries, the economy's been booming. There's quite a bit of accumulated wealth that's searching the world, particularly the cities that international travelers are accustomed to visiting. New York, Florida, San Francisco, the resort areas of Aspen, Hawaii, some of these places have received quite a bit of overseas demand. In many cases, the real estate looks quite cheap on an international basis. There's been a couple of events recently, one being the crisis in Greece, the renewed crisis in Greece, things with the Osama event surrounding Osama bin Laden and other things that make it look like we might be at a stable spot in the U.S. dollar that will ultimately help with our commodity prices and make some of the upward pressure on these commodities look a little less severe. But still, there are tremendous values in U.S. dollar assets, including our residential real estate. Here's our group. If you have any questions today, I'm John Mulville. My contact information is shown here. You can call me and discuss anything that pertains to our webinar today or any topics covering the market in general. Mark Bowd, many of you know Mark. He's the principal and founder of Real Estate Economics. Our sales and support team is Judy Duell and Sandy Rivera. If you're interested in a residential economic report, how to access these webinars, or if you're a current subscriber using our products and would like to make sure you're adequately trained and that your staff knows how to use those, contact Sandy Rivera. Thank you so much for joining us today. Again, refer any questions to me. I'm John Mulville. Please join us for our upcoming webinars and view us on YouTube for our past presentations.